Well, I think the Fed was generally optimistic as expected, noting that we did see above trend activity in the second quarter, but they were quick to temper those expectations and point to one-offs that really drove that increase above 4%, and also noting some red flags in the economy as we do see some slowing momentum, particularly in the housing market. And many Fed officials pointing to potential downside risks, not from fundamentals in the economy, but from fiscal policy, as you noted, particularly talking about trade. And while some did point to the impact already having taking a toll on the economy, the uncertainty surrounding the potential negative impact could force the Fed to slow the pace of rate increases. So really opening themselves up, giving a little more wiggle room in terms of that longer-term pathway for rates. The Fed is going to look at what's happening in the economy as well as their expectation for what's going to be happening in the economy. September rate increase, very much baked in, but that end of the year increase remains a question mark for Fed policy.
Okay, that was where I was going. Did anything in there help you decide about December, or is it just as questionable as it was before we got these minutes?
I think it's even more questionable. I think that the fact that the Fed is pointing to downside risks is really setting the table for we may or we may not raise rates at the end of the year, depending on how the economy is faring. If we start to see the trade war take its toll and we see a further pullback in the consumer, a further pullback in business investment, the Fed is equally willing to pause or delay that additional rate increase. So I think the Fed is, again, giving themselves a little more wiggle room in terms of expectation for policy.
Is that what you hear, Michael?
It is what I hear, Tyler, and I think, you're hearing that the Fed is recognizing, I think, that they've painted themselves into a very uncomfortable corner, right? I mean, they've got good economic growth right now. I mean, we've got this 4% number. It's probably not going to continue that way. But if the Fed had come out with something more dovish, and I'd be interested in what Lindsey thinks, if we heard that they were going to, had said that they're going to have one more rate hike and that's it, and they're not going to do anything in December, Lindsey, I think stock prices would rally hugely on that sort of a dovish tone out of the Fed, and that further builds a bubble that they've got to worry about down the road, doesn't it?
Well, it could, but remember, I think the Fed is going to be very cautious in their language. They're going to remind investors, as the chairman did with the two-little-word phrase, "for now," that they have not committed to any pathway, that it's going to depend on the evolution of the economy in terms of growth, inflation, and the other fundamentals driving the domestic economy. And so, as you said, they did seem to paint themselves into a little bit of a corner, and now they're walking back from that, so reminding us that they have not committed to anything. These are expectations, these are forecasts, but certainly if they did take a little more of a dovish tone, saying, look, we're going to give the economy a little more room to run, that's absolutely positive for the equity market.
So, Michael, how do you weigh this? It's sort of a push-pull. I mean, on the one hand, you're hearing the Fed say, we'll respond accordingly, and if it shows that we shouldn't be raising rates, maybe that December rate hike will be in question. Maybe we'll reconsider that. At the same time, we're also hearing loud and clear that trade disputes are potentially consequential, to use their language, risk to the economy.
Well, I think that's there's no question. So I have been leaning for quite a while, Melissa, to say I think there's a good chance that they will pause after this September rate hike. I'm not sure if they should. Expectations are still that they're going to raise 3 more times. So that's 3/4 of a point on top of this range that's already 1 3/4 to 2. So if you go to 2 3/4% on the Fed funds rate, that takes you right now to the 10-year Treasury yield of about a 282. So you pretty much have the Fed inverting the yield curve, or if the yield doesn't, on the 10 or the 30 doesn't move up, the 30-year now is still under 3%. So these yields have remained very robust. I think they're in a very tight place, because if our yields go higher, then the foreign money comes in and the dollar gets very strong. And as the dollar gets very strong, we have a big headwind to GDP growth all over again. That's the corner they've painted themselves into.